So we're coming to the final session of this morning, and we'll be focusing on the tech sector in Singapore. Yes, some of you might be surprised. We do have a growing tech sector here. It is very vibrant, and there are very, very prominent Singapore tech stocks. And to tell us all about them, we're glad to have Mr. William Tung, also from CGS-CIMB. He's got over 25 years of equity research experience, and he'll be sharing with you what to look out for if you want to invest in Singapore tech. Over to you, William.
Okay, good morning, everybody. Just give me a minute. Sorry, there's a bit of lag. Just give me a minute. Okay, good morning, everybody. I think you can see the slides now. So if you can't see the slides or if I'm not coming out clear, just please let the moderator know. I think they'll feedback to me. So thank you for this morning sessions. So we are actually going to talk about Singapore tech sector. So I actually cover the tech manufacturing stocks listed in Singapore. So in this session, I'll try to keep it short. I'll try to make more time for Q&A. Basically, we'll go over the outlook for the semicon related stocks, tech manufacturing stocks in Singapore, the key risks to be aware of, and also our views on the 5 semicon stocks that we cover. So before we actually start, as usual, please be aware of your own financial situation, as well as if you actually need further clarification before you make any investments, please do be sure to talk to your respective financial advisors or brokers, or if you're actually CGS-CIMB client, please have a chat with your CGS-CIMB representatives before you embark on any of these investments, because some of these tech manufacturing stocks, they actually can be quite volatile. As you can see, I think that's what Mr. Ho already shared one of the chart of AEM. So the stocks tend to be high in beta, and they tend to be can actually be quite volatile. So the risk reward profile might not suit you. So please be aware of that. So when we talk about the Singapore tech sector itself, just to highlight that basically when I look at the Singapore tech manufacturing stock, if you look at the semicon related basket, which is what I call them, so we have actually 5 stocks here on this page: AEM, Franken, Grand Venture, Isdn, as well as Ums Holdings. So these 5 stocks are basically semicon related, but of course they do have varying degree of exposure to the semicon industry. So if you look at it, AEM as well as Grand Venture and UMS will actually have very high percentage of revenue coming from semicon related business, whereas Franken as well as Isdn will actually have a lower percentage of their revenue coming from the semicon business. We actually also put Isdn here just for simplicity, as although they are not directly involved in the semicon, they do actually sort of like service the automation business, and there is a bit of semicon relation as well as semicon customers there. So with that, let me move on to the next slide, where what is actually driving all this demand for the chips, or what is actually driving this demand for the shares or the share price that you're actually seeing in Singapore. Basically, really has to do a lot with the chips. So on this chart, what I'm trying to show you is this comes from Statista as well as the WSTS. What I'm actually trying to show you is actually the global sales of semiconductors. So if you actually recall, this chart actually goes all the way back to 1987 to the latest forecast that they have released for 2021 and 2022. So when we look at this chart on the extreme left that you're seeing, you can actually see that back in the 87, 88, 89 is a very small market. I mean, in terms of the chips that you actually have, the sales is talking about 33 billion US dollars. So what has actually happened, if you recall then, is basically these are all the PC related. During the era is the very early days of the desktop computing, where you actually have all these x86 type of PC processors. And then subsequently, as you move on, you start to see that the chip sales has actually started to increase. Primarily, the next big cycle that came is actually in terms of a mobile phone. If you remember, last time we used to have Motorola, We used to have Nokia, Sony Ericsson, the early days of all these GSM handphones. So one big revolution came when iPhone came along, smartphones basically as they call them now. And why are they so smartphones? Because they can do a lot of things. So for example, even today, when you ask questions on Slido, you're actually using a smartphone function. You can actually choose to do that, or you can actually listening to this call on your Zoom app on the mobile phone itself. So you look at how that has changed in terms of the global semicon sales. That has actually pushed the revenues of such chips actually all the way up to actually in 2020, they're talking about 400 over billion. In 2021, the forecast is about 553 billion. And then 2022 is about 601. And people are talking about this industry hitting $1 trillion US. And along the way, you have actually seen another big driver that has moved is actually your electric vehicles. So I'll probably talk a little bit more on that in the next slide. So in the next slide, or in this slide, so some of the main things that I have mentioned just now in terms of the demand, you start to see that the demand has become what we call more secular, meaning to say that it's actually a very electrification of things. So you are starting to see, we'll just start on the demand issue first, which is basically your extreme right, the 4 slides. So you look at this 1-2 years, you are now moving in terms of mobile phones, you are moving to 5G. Obviously, it's not going to start at 5G. You're going to move to 6G and more growing cases. So why is this important is that as you have more and more, not just data connectivity, but faster bandwidth and so on, there are more things that you can think of in terms of what you can actually apply them for. So it might not be very clear to us now, like 5G, 6G, how do we apply them? But as this data transmission gets faster and faster, for example, in let's say you have some unfortunate case where there's some accident on the road or something, the ambulance can arrive, you can actually start monitoring all the patient vital statistics, you can actually start transmitting all this data to the hospital, to the A&E, the waiting medical team. They will actually have all this data relevant and already in place so they can make a faster assessment and move the case on a faster basis. This is just one of the simple sort of things that you can think of in terms of using that. Of course, you can also think in terms of like firefighting drones. You can have 5G, 6G equipped firefighting drones, which you can actually, instead of having to deploy your hoses and to start your water, you can actually sort of have drones that can actually fly out of higher floors to actually start the firefighting process as you actually deploy the hoses and so on. So just like I also mentioned electric vehicle, you will see that in terms of electric vehicle, I think you were just really starting to see the beginning of this drive towards autonomous driving. In Germany itself, they have reached what we call a level 3 driving. So when you think about these electric vehicles and autonomous driving, right, the key thing I would suppose is when we look at cars back in our old days, very simple cars, petrol driven, you don't have very much electronics. Even I think it took quite a while, probably up to only in terms of the probably around 1991, that kind of 80-something, 88, 89 era, you're only talking about things like power windows, power steering. Today, you have so many things like, some of the cars can do self-assisted driving. You can actually hands off on the expressway, they can drive by themselves. You can also have cars that can actually park by themselves. So all these will rely on electronics, whether it's sensors, whether it's camera systems, modules, or radar system, LiDAR they call it. So all these, once you get into this, you can actually go and Google for all this information. Infineon is a big supplier of all these chips. So basically the whole concept is that from last time where you had very little, say maybe a few, maybe tens of chips or a few dollars worth of chips, you are not talking about thousands of chips. You're talking about maybe a lot more in terms of the dollars of the value of semicon in these cars. And you actually can notice that the trend is that nowadays you can't really go to any workshop to have a car repaired because all the cars are they actually have a computer inside. So you actually would want to go back to your authorized car seller because they will actually have the systems to plug in to see what is wrong with the car itself. And in terms of software updates, you also notice that it's also quite a lot more expensive. I mean, if you actually have parts to replace and there are electronics involved, you're going to have to pay a lot more especially for those replacement. The other thing that you actually will notice around you is what they call Internet of Things. And I think this one is actually not so obvious last time, but actually nowadays it's actually quite obvious. Chips have very different type of chips. I mean, it can be a simple chip, it can be a very, very complicated chip. But basically, whenever you have anything that involves all these electronics that helps you in terms of automation, you will need chip. And therefore, that is actually sort of contributing to the demand for chip. So nowadays, we no longer even have to carry keys. You can have your smart doors. Your doors can be open automatically by your app, by your finger sensor. All these things, they will actually need chips. Even nowadays, your aircon, you actually have options to control. You do not even need remote control if you don't want to. You actually can control your handphone. You can download apps to control your handphones. You can also have smart features, which actually can even tell you that, oh, this item is expiring soon, you need to order. Even to the extent that I think you can actually, if you're comfortable, can have it automated, that they will actually send the automated delivery orders to whichever vendor that you're using. So why I highlight all this is that when you look back into the internet era, these things were actually all suggested before, back in the internet era, when the web was just sort of coming alive. Those were back in the 2002 days. People already writing articles. We go and check all these economics articles. They were already suggesting all these things, but it has taken this many years for actually the industry to actually be able to come up in terms of chips, in terms of products, in terms of miniaturization, as in terms of access, whether it's 5G, 4G, or data access through Wi-Fi. And going forward, you are not going to see it stop at here because you actually already seeing a new category of product like smartwatches, which never existed. Today, you can either have Fitbit, you can have Garmin, you can have Apple watches, which can do a lot of things. They can actually monitor your blood pressure, how many steps you have taken. They can link it to apps to tell you what is your record for this week, how much you need to step up on, how much you need to monitor your diet, and all these things. And also the other one is going forward, probably in the next 1 year, 2 years, is going to become more and more real, is smart glasses. So not only your eyewear that you're wearing today, they can actually do a lot more in terms of what they can actually do for you in terms of the communication or interaction, the virtual world. And of course, the thing that like Facebook is trying to go in to create a metaverse where you can actually interact virtually and so on. Those will actually create a demand for a lot of chips, like graphic usage chips that NVIDIA is actually doing. So you have a whole new category of things that is actually going on. And I think along the way, we'll probably be surprised by other things that will actually see more electrification. The last demand that I'll talk about is the artificial intelligence chips. So these are probably not so much for the everyday man on the street, but in terms of how work processes are changing, in terms of the factory floor space, you are actually seeing that a lot of companies are actually now, especially with the COVID, employing a lot of automation, employing a lot of remote monitoring, and employing a lot of so-called robot. Two levels of it. One is what they call cobot, which is the manual worker is assisted by robots, or the other one is they're actually trying to do more and more robotic involved production and to reduce the reliance on labor. So instead of having workers to do it, you actually have more skilled like supervisor or skilled technicians that can actually operate some of this equipment. So if you move back to the extreme left, what we're going to talk about is in terms of what actually also causes this demand. The items that we talked about previously, those are actually mainly more what is creating the demand that we can actually see in the coming next 3 to 5 years. And in my personal view, I think it's just going to continue. But two things also happen that is actually not related to this. One is the US-China geopolitical issue. So definitely because of the rise of China, I think that there is also concerns in terms of the US side as well as the European side. So you actually start to see reshoring, what we call reshoring, meaning to say that these countries, these geographies are interested to have more of such manufacturing related work, more of this chip manufacturing go back to where their own country. So in the US and even in Europe, they are actually starting to have a lot of government-led or government-funded incentives for all these chip makers to actually try to make more of those chips at home. So you actually see companies like Intel announcing fabs in the US and also just recently, a few weeks ago, announced investments in Europe. So that's one thing that is actually not going to change also, and that actually creates that adds to that demand. The other thing, this is really totally unforeseen, was the COVID-19 outbreak, and what that has caused is that has actually accelerated in terms of the digitalization and automation. Because when you have the COVID-19 outbreak, there is a lot of restriction in terms of movements, in terms of lockdown, in terms of safe distancing, and that has actually really accelerated the process of trying to use less labor in your production process. So let me move on to the next slide, where we are going to discuss some of the key macro risks that we actually should look at before we actually go on to look at the individual stocks that we are positive on. So what I want to say is that in terms of the valuation risks on the extreme left, that's the big one. I think most people are quite aware by now that we are actually going to higher interest rate environment. So if you actually were in the morning's session on the REITs, they actually did focus quite a lot on interest rate, whether it's 190 basis point, whether it's 250 basis point. So how does that affect us in terms of the tech valuation? Is generally speaking, because of the relationship between interest rate and PE multiples, which most in the industry use to value stocks. As your interest rate goes higher, you would naturally have that PE derating. So in terms of valuation on a PE basis, generally you will suffer a derating. So investors in general will actually be less willing to pay higher higher PE multiples for these stocks. And the other thing, which is more from a short-term trading perspective that one actually needs to take note of, is that as the market factors in all these interest rate movements, then for the Nasdaq, because the Singapore market actually does follow the Nasdaq quite a lot, people tend to look at it on a trading basis, what happens to the Nasdaq overnight, are the US markets up or down? So that is actually going to have an impact on the short-term share price movements of the stocks that we are going to recommend. So on the second bar that we have is more what is a component shortage situation. So there is an ongoing component shortage. Part of that is actually due to the trade war, as well as part of that is due to COVID-19 impact. But generally, it's also due to demand, especially from the automotive side, where they're actually demanding more in terms of chip components. So I think the general news or feedback from most of the companies that if you actually go and read on Google is that the situation is not as bad as what it used to be, but it is still there. So the situation is improving, but it is not a satisfactory situation. So they are still facing issues with getting components. They are still having to hold higher inventory. So without this component shortage, with more normalization, I think most of the companies will actually do better and also have sort of lesser price pressure in terms of the component side, the chip side, where they may have to pay higher prices as well as the whole inventory. So the next one that we talk about is the COVID-19 already. So we know that with COVID-19, we already have, not so much in Singapore probably, but in Malaysia, where there's quite a fair bit of manufacturing, you have seen all these movement control order. And last year, you have definitely seen that in the quarters, companies have actually been affected because of the lack of availability of workers. And China actually does still basically maintains a zero COVID policy. So they are still in the process where they try to contain by locking down entire cities. So recently we have already seen Shenzhen and Dongguan part where they actually have done such lockdowns. So actually there is a risk factor to be aware of because China still is quite a big player in terms of manufacturing for not just electronics, but for quite a lot of products. But on the other hand, on this China zero COVID policy issue, you actually also notice that recently, although they are still applying it, there seems to be willingness to exercise a little bit of flexibility. So two things to note on that, being to say that even on the Shenzhen Dongguan part, they are actually willing to allow some of the companies to open up or resume production slightly earlier. And even in places like Shanghai, I think they are also sort of slightly more receptive to having, instead of having a total lockdown of factory, if you can demonstrate that you have like able to contain your workers, you have some kind of bubble where certain group of workers are working in a certain designated area, there's no interaction, all this, and you do your regular testings, your workers are vaccinated, they are actually willing to be sort of exercise more discretion in allowing you not to have a big shutdown. So that is in terms of COVID. And the last one is in terms of the Russia-Ukraine, which some of the speakers have also mentioned. That definitely is going to be a risk because of a few things. One is the impact on the energy, mainly the oil prices. And on oil prices, you also, if you follow the industry, you know that China last year actually also had energy availability issue. So if you do have plants in China, you actually could face restrictions in terms of your ability to actually do production. And as the oil prices increase, then definitely this is going to be an issue. The other one is in terms of raw materials such as aluminium and stainless steel. So although there are alternatives suppliers and therefore not so bad in this instance, Russia actually is quite a big player still in this where aluminum and stainless steel is concerned. So the thing is that this Russia-Ukraine conflict, an earlier resolution is better for companies rather than a long drag out one. So if this really actually gets dragged into second half, into a 1 year scenario, I think you will see more disruptions. And the last point is in terms of rare gases that are used for semicon manufacturing, such as neon gas, in which Ukraine is actually one of the big supplier. So in that area, what is happening is that I think short-term wise, meaning to say for now, for the next 3 months, you might not get too much of an impact in terms of actual chip production. Basically because there are alternatives, you can try to do a bit of substitution, although it's not ideal. And also generally there are inventory. So these chip makers, they actually do have some stock. This stock might not be a 1 year supply of stock. It could just be a few months, which is why I mentioned a 2 to 3 months time frame. So if this gets dragged onto 1 year and so on, it's going to cause an issue. And overall, because if all these things, higher interest rate, your war scenarios getting dragged on, it will eventually also filter down to economic growth, and consumer demand will actually be affected if economies head into a recession. Because not forgetting, some of these users of chips are actually consumer demand related, smartphones, your computers, and also your watches. All this can be consumer demand related. Even your shopping or your data centers, they ultimately also depends on the consumer side of things. So these are some of the key risks that you want to take note of. And with that, maybe let me move on to the 5 stocks that we're recommending. So the first one is Isdn Holdings. This, to keep it simple, the business model is actually currently now 2 main sort of revenue streams. The first one is what they used to be doing. That's about 2/3 of revenue. They are actually the sole supplier still of a product that is called a test handler. And they are this supplier to Intel. And Intel uses such handlers in their new generation testing. The other business is a contract manufacturing business, which they actually acquired last year. They actually acquired another Singapore listed high mix, low volume contract manufacturer. That's a company called CEI, which roughly accounts for 1/3 of their FY21 revenue. So why do we recommend an ad on AEM? This is the only company you notice in Singapore that gives you a revenue guidance. So they have guided that this year's revenue, FY22, is going to be between 670 to 720 million. So if you compare this to what they actually achieved in FY21, this is an 18 to 27% year-on-year growth. So they are still in for growth despite all the risks that I've highlighted in the previous slide. And you also notice that if you actually go and check their announcements, they actually tend, because of the fact that they're actually giving revenue guidance, I think in terms of how most people who actually do it, you will actually try to want to be conservative and to make sure that whatever you're issuing is something that you can actually achieve. So track record wise, they have actually done more than what they have guided in terms of the revenue. So the key risk here, I would say, is whether they get to retain their sole supplier status, which as of now, what we can tell based on engagement in companies as well as what we can read from the industry, they still remain the sole supplier, which therefore moves you on to the next what can they actually do to reduce this sole supplier status? So the answer to that has got to do with this issue of customer diversification and how they are going to achieve this customer diversification. Previously, you already saw that they actually did acquisition of CEI, and that has actually brought down the revenue dependence from the semicon side down by 1/3. So in terms of what else they can do, I think it's not to really diversify in anything unrelated, but to focus more on their core strength. Semicon is their core strength. So what they can do is they can actually offer customers something called system level testing. And why they can do that is because they actually have been doing test handler that is involved in system level testing for Intel itself. And therefore, they have actually able to come out with a new system, which I'll show you on the next page. It is called AMPS platform, which basically stands for Asynchronous Modular Platform. So what they actually try to do is there is a growing demand for system level testing, and that is being driven by a complexity of chips. If you read the news in the tech space, you see that people are actually going for what they call a smaller geometry, basically your 5 nanometers, 3 nanometers. So when they say going for this lower geometries, right, it basically means that the chips get more and more complicated. So the risk of having failure, the risk of some of those transistors not being tested increases a lot, which is why they have to resort to this thing called system level testing. And AM has actually announced that they have actually engaged 2 customers, and they have actually, although they are not able to give you further details on customers due to confidentiality agreements, they actually did guided that for FY22, such new customers may actually be able to make up 10% of that revenue. So I think that the quantum itself is sort of not so important at this point in time. But what is more important is that they are making good progress in terms of trying to address investors' concerns of the need for diversification. And the last point to take note of is for AEM, you notice also that they have a strong balance sheet. So if you look at historical numbers, as at December 2021, they have a net cash, meaning to say you take the cash less their bank borrowings, they have net cash of 135 million. They actually have just a cash balance itself is 216 million. So this gives them quite a sizable war chest to actually grow further via not just acquisition, but a more meaningful acquisition that can actually either be customer acquisition or can actually help more in terms of the bottom line. And you also notice that in terms of shareholding structure, we can only see the Temasek Holdings basically as the main shareholder now, which is roughly about 11% shareholding stake. So if there are interested suitors who wants to do an acquisition of AEM, there is actually shareholding wise, there's actually not much that will actually be in the way. So it will really come down to valuation and offer, what is the offer, and whether this fits the acquirer's intention, as well as whether this fits what AEM itself actually can achieve. So on this next slide, you can actually see this is what their AMPS platform looks like. And this is basically from one of their presentation slides. So what they're actually trying to do down here, if you look on the extreme right, you can actually see that in the full production model, they're actually going to have the white thing is actually the so-called the test handler. And so here you're going to have a one test handler to many testers scenario, which is why it will actually help them. So with that, let me move on to the valuation part, where we have set a 685 target price. So I just want to highlight to you in terms of how CGS-CIMB does valuation, we do it on a PE basis. So take note that when we do our valuation, it is on our FY 2023 forecast and not 2022 as what most of our markets will use. So we are valuing it at 15.6 times, and that's how we got the 685 TP. And the risk we actually mentioned just now already, the loss of supplier status, that can be a very big risk. And the diversification, why I actually talked quite a fair bit on diversification just now, is that because if you are actually depending on 2/3 of your revenue from Intel, if anytime there is a order cycle that is actually going off the cliff, going on a downtrend, you can be sort of quite badly affected. So diversification to actually balance out that is going to be important. So I'll move on next to the second company, which is Grand Venture. This is also quite a high semicon related company. So before that, what they actually do in simple terms is they are mainly more like a machining company. So what they do is they actually precision machine metal related components, and they do a bit of sub-module assembly. So semicon exposure is about 71%, but they actually do have life science at 16% and other segments such as medical electronics at 13%. And on this slide, you can also see some of the customers that you might be familiar with, people like this Teradyne in terms of the semicon, as well as SciEx and Thermo Fisher for the life sciences part. So for us, this company is an ad. I think the key thing that stands out for this company is also one of the rare companies in the Singapore space that is a very growth-focused management team. So the company really has got ambition of growth, and essentially they have actually done 3 rounds of fundraising to actually support their growth plan. So if you recall, they actually did an IPO, and one of the very rare companies that has not taken out money via dividends at the IPO stage. So they have actually not dividend out any money prior to IPO. And after that, they have done 2 placements, one to Novotelis and as well as one to institutional investors. And you have seen that in terms of execution, they have actually really deployed the proceeds to do M&As recently to add capacity, add new customers, and to enter different business segments such as aerospace. And also in addition, they actually do have a China presence, but in terms of how they think about things, China is more for a local market, so they will try to do China production for China demand, as well as to do most of the overseas demand by MNC's customers out in Malaysia as well as Singapore. And therefore, I think they will benefit from the ongoing trend where it's now increasingly popular with MNCs to have a China plus one approach. And also the other thing that if you recall, I mentioned they actually do assembly, sub-module assembly. So they are actually looking to increase wallet share with customers. So try to do more components as well as move more into related higher level assembly, meaning to say because they are not set up to actually assemble some of the cost competitive products, so they'll be more focused and try to do some of the assembly that is harder. So basically, this is actually going to drive their growth. Valuation wise, we have it at 160. Again, it's PE based at 14.5 times 2023 forecast. And the other thing that you want to take note of is when you want to actually grow aggressively, there is a dilemma. Because if you actually spend a lot on M&A as well as spend a lot of capacity expansion, it could affect short-term forecast. So I would say that if you ask me for earnings risk on our 2022 numbers, if they actually do more aggressive M&A, meaning to say that they actually go and have to add further debt, and as interest rates are going up, interest expense could be higher, or they spend more on capacity. This could pose a short-term earnings risk to our FY22 forecast. Although I think that this is probably the right thing to do for our shareholders who are actually more interested in the long-term outlook of the company. So with that, I'll move on to Ums Holdings. Again, Ums Holdings is quite similar to Grand Venture. They are also a precision machining metal-related company. So the key difference here is that they are in the semicon space, they are essentially applied materials. So for applied materials, they actually do two things. One is they do components. The other one is they do sub-assembly module. Sub-assemble module is actually a wafer transfer module for applied materials where they actually have a 3-year contract and they currently have an allocation of about 70%. So in terms of what they are trying to do over the years to actually reduce the concentration of applied materials, again, is diversification. And in this case, if you actually look at the long history of UMS, they have actually been involved in the aerospace industry before, but they actually were not able to make good headways there because their strength actually quite mainly in semicon. But actually last year they have acquired almost a 72% stake in JEP, and JEP actually does have this aerospace contribution and actually tend to be more aerospace focused. So aerospace is probably about 4% of FY21 revenue for UMS. And I think for the JEP acquisition, two positive things on it. One is because Semicon is doing so well now that there is this capacity issue. So even UMS actually don't have enough capacity now where Semicon business is concerned. So they're actually able to pass on some of the customer requirement or demand to JEP, which has that machining capacity, because JEP business was actually affected by the aerospace part of things. But as you have seen, Singapore is actually moving forward to actually try to live with the virus and with announced measures. I think even in the US, European countries, they are actually trying to reduce all these measures. So as things progress on, aerospace will be making a comeback. And when aerospace makes a comeback, then the business, aerospace-related business at JEP can actually see a gradual pickup, which will actually be positive in time to come for UMS. So UMS is an ad because as far as we can tell, in the results briefing, they are still guiding that orders from key customer applied materials continue to be strong. If you look at applied materials' own press releases or the investor conference or transcripts that they give, they continue to see strong demand for their products. And actually, UMS has also announced that they will actually have a new factory in Penang. And this is actually scheduled for completion by end of this year. Again, here the risk is all this consumer schedule, everything is subjected to how COVID develops. But assuming that is end 2022 completed, it will actually increase their production capacity by a fair bit, and they will actually be well positioned to take on orders from potential new customers that wants to expand in Southeast Asia. And then the last point I already mentioned, as the aviation industry recover, they will actually see a gradual recovery. So maybe on this, just a point to highlight or to note is that you actually, if you actually read the press, last year, Lam Research, which is another big player in terms of the front-end semiconductor equipment, actually announced a very big plant in Penang in Malaysia. And obviously, I think if you were a businessman in that region, all the suppliers or all these companies will actually be trying to get to do business with Lam Research. So having ready capacity to show to Lam Research that you know, if you actually have the business, will have the capacity ready for you. This will actually help you in terms of your positioning. So valuation-wise, the target price is 163, and this is based on roughly about 14.5 times PE multiple. We actually use what they achieved in the last cycle. The last cycle for them was about 16, FY 16 to 18, the last profit up cycle for them. So that was how we actually derived our TP. But you also want to note that although fundamentals are strong, demand is there, it's much more an execution issue. They do have one specific risk, that is the higher tax rates issue. So what has happened is that they actually have a pioneer tax incentives or one a subsidiary in Malaysia. But unfortunately, because of the COVID situation, they did not hit the minimum hiring requirement. There is a certain percentage, I think it's roughly 80% or 70+% of the workforce that must be Malaysian. So they were not able to hit that percentage last year. And therefore, they actually had to make a higher tax provision when they announced a 4Q21 results. So this currently is still in negotiation. They have escalated these matters to the higher Malaysian government levels, but we probably wouldn't be able to know what the negotiation status are until until the next 3 to 6 months. So that will be one factor to actually to be aware of. And with that, let me move on to the next company, which is basically Franken. Franken, again, is also very similar business to your Grand Venture as well as UMS. Here, you are talking about machining, precision machining of metal-related alloy components and submodule assembly. But the key difference here, if you look at this slide, is you can see that semicon typically is not such high concentration. If you look back, maybe in 1817, you'll notice that roughly speaking, all the segments that I'm showing here except the consumers and industrial and others and tooling, the 5 key segments were left: your semicon, medical, analytical, industrial automation, automotive. On general, is about 20% of revenue. But last year, you notice that semicon, because semicon industry is doing so well, we have 38% from semicon, we have 13 from medical, about 20 for analytical, 14 from industrial automation, and 10 from automotive. So why I actually put this slide here is to highlight to you that automotive, that 11% that you see down there, is mainly a plastic injection molding business, and it's one of those legacy business that they have. And here, the difficulty is that they don't have the scale. So it can be quite price competitive. And without the scale, they're actually not able to offset the price competitiveness with the volumes that is required. And how they actually try to overcome this is try to have a lot of cost measurements, productivity, as well as try to do things differently. So meaning to say, instead of what we would call just dumb plastic, meaning to say you just inject a plastic part, they actually try to move into higher value added things. Another product which is called Eco PVD, which is basically a plasticization of all these components, the metallization of these plastic components that are used in cars for some of the radar or the antennas used in cars. So this is an ad in terms of how they are guiding. They are guiding about half-on-half revenue growth. So momentum continues to be good even on the half-on-half basis. That is, first half of this year versus second half of last year, they continue to expect revenue to be growing, despite what we are hearing in terms of macro risk. They actually acquired a unlisted company called AVMAC in September last year. This again helps in terms of the production capacity. Because notice that I've been talking about capacity limitation both at Grand Venture, UMS. So this will help in terms of capacity expansion or production capacity availability. And you also notice it is a similar strategy. AVMAC actually has exposure to the aerospace industry again. So from these 3 companies' move, you can actually tell that they actually do see strong demand or strong prospects for the aerospace industry. So in terms of automotive, the outlook that they are guiding is they expect it to improve. They are actually still profitable in the business versus last time when they actually didn't have this plastic metallization product that they actually managed to launch. So I think in terms of the segment for this segment performance, at least you will not see them slip into a loss most likely. So valuation-wise, we have here 163. Again, this is based on PE. And also, this is main risk is actually more the ongoing Ukraine-Russia conflict. And in terms of the Ukraine-Russia conflict, we highlight this here is mainly because of ASML. In the semicon space, one of the key customers is ASML, and without a machine from ASML, it's actually quite hard to actually be making the chips. But of course, although I highlight this here, I don't really think that these are short-term disruptions. In the long term, because when Intel announces the fabs, you're talking about 10 billion, 20 billion investments. It's not something that you can actually stop just because there is an ongoing Ukraine-Russia conflict. It's a very long-term commitment. The fabs won't even come online up to 2023, 24, 25 timeframe. So I don't think this is going to derail all these investment plans. So the last company to highlight here, although it is strictly not semicon related entirely, is Isdn Holdings. They are basically a big beneficiary of industrial automation solutions. This industrial automation solution business accounts for almost 98% of FY21 revenue. They are quite diversified in terms of number of customers that they have. They probably have more than 10,000 customers, and they have actually quite a big presence in Asia, spanning 55 offices. But again, the risk you want to take note of is that they actually have a big presence in China. It's a key market for them also. Almost 3/4 of revenue come from China itself. And if you look at their business, they are, I would call them like a value-added reseller system integrator, meaning to say that they are a distributor. They distribute products from Maximum Motors, which is a private Swiss manufacturer of high-precision drive systems. So you are not looking at those very like cheap motors that anybody can do. So they have a very strong relationship with Maximum Motors for many, many years. And what they're actually doing, because we look at the gross margin, they are doing 20+% gross margin, which basically tells you that they are actually taking their role as a distributor and going to customers to suggest solutions and to actually integrate for customers, which is why they can enjoy this high level of gross margin. So segment-wise, they serve is quite widespread: semiconductors, industry 4.0 manufacturing, medical devices, as well as aerospace. And again, the main thesis for the ad is the demand for industrial automation remaining strong, because you actually not just seeing the rising labor costs throughout Asia, and also because of COVID. And actually, if you look at the news flow in China, the younger generation is actually quite different already from the older generation, their parents' generation, where they actually work more in the factories. So conditions are getting different, and it's getting harder to get factory workers. And also nowadays, automation, you can actually integrate with a lot of artificial intelligence to actually create data analytics that will help you make better use of data. And the last point to take note of is actually a possible earnings surprise, because they do have a mini hydropower business in Indonesia, which although has taken them many years, they are probably currently at the very, very last stage of really looking at possible contribution from this business in this year. So valuation-wise is 96 cents and roughly about 12 times PE multiple. So in terms of opportunity, I already mentioned that just not the hydropower business. So why we reiterate that here is basically, if you look at hydropower business, has been really very long time in the process for the company. So I think if whenever they are able to actually better update the market on what is happening on the hydropower business earnings potential, as well as whether they're going to monetize this, whether through a trade sale or whether via IPO to remove it, be able to fund and grow for itself, that could actually be a positive catalyst for the share price. And obviously, on the flip side, the risk will be further delays for these hydro projects, as well as if you have actually have further capital injection needed to actually grow this business. So with that, end the presentation here, and let's we move on to Q&A. Oh, sorry.
William, there's
sorry.
questions for you.
Yeah. Yes, please go ahead. You want?
So I think the first one from Jason, and it's something that you've already addressed, but I think it's worth talking more about in detail. There is still a chip shortage, and it looks like it may go on for quite a while. So of the stocks that you've been talking about, which ones do you think will be most impacted by it, either negatively or positively?
Okay. I think, okay, maybe the positive one, which a quicker answer will be available. On the positive side, right, because you have a chip shortage, so what you actually want to do is you want to make more chips. So to make more chips, you actually need what they call foundries or the wafer manufacturers, wafer foundries are basically. So these are actually people like our TSMC, people like our Intel, and therefore that's why we actually mentioned the first company that we actually quite positive on is AEM. So Intel itself actually announced in the US, probably I think if I remember correctly, it's about 4 fabs, and they also announced that they're going to do like 1 or 2 in the Europe space. So to actually do that, indirectly, when they actually have all this production coming on, they were actually assuming that they actually retain all their testing and assembly function. They will actually need to do more testing and assembly, and therefore that is why you will need more products from AEM. That product is called the test handler. Then the other beneficiary will probably be your people like this Franken, as well as this Grand Venture, as well as UMS. So Franken, remember just now I mentioned ASML. So ASML makes machine that's involved in what you call lithography. So you need these machines to actually etch out the chip patterns. So your TSMC or your Intel will actually need machines from ASML, and Franken is involved in supplying components to ASML. And similarly, the same concept holds in terms of this Grand Venture as well as UMS, as they supply another company in the front end part called Applied Materials. So in terms of the negative aspect, who can be negatively affected by these chip shortages, right? Generally speaking, for these companies, not so much, except that they actually will actually need some of these chips when they actually make the product for the end customers. But they are not like a very big user of such chips. So what we are talking about is that if you are saying negatively affected, you will think more like contract manufacturers, somebody who does, for example, if you look at Aztec, where they do smart security cameras, you actually need chips for that. So without chips for it, you will actually have difficulty to make the end product for customers. So those maker of real end consumer products, you actually face a bigger issue compared to all these semicon makers or semicon companies that helps in the process of making the chips. And also possibly Isdn, because they actually don't make, they actually are a distributor. So if Maxon and their other principals are not able to have enough chips to make the product, they can be a little bit more affected. But in Isdn's case, because they do have some degree of diversification and they have good relationship and being very long in the industry, I think overall I would say that for the semicon side, this basket of 5 stocks that I mentioned, they are actually more positive than negative.
Thanks for that, William. And we're going to move on to the next question. Just a quick clarification. FH Tan is asking why your target price for Franken is about 1.63. Actually, your target price for Franken is 2.06, right?
Hang on, I might have made, let me just double check. Yeah. Yeah, that's right. I think maybe there's some transcript error on that, yes. You can actually, yeah, so if you look at this slide, actually, can you see the slide just to check?
Okay, let's get our tech team to bring up the slide for the top picks on the page. Let's see if we can bring that up. All right, we've got that up right now.
You can see the slide, right, just to confirm?
Yes.
Okay, yeah, so I think there's a transcript error. So yes, you're right. It should be 206 for Franken. Yeah. 206
for Franken. So yes. FH Tan, we're just clarifying that. We're going to move on to the next question now, William. And then somebody is actually asking you to rank the companies that you're looking at. I don't know how comfortable you are with that, but perhaps you have some that you prefer over the others.
Yeah, sure, no issues. So before we move on to that, actually, I think in response to FH Tan's question also, you can actually sign up to be a CGS-CIMB client. I think Mr. Ho in the previous session I shared, we actually do make some of this research available to our clients. So in case I have any transcript errors from those the research portal and all this, you can actually get the latest report. So in terms of ranking, right, I would say that how I think about it is that I would say that AEM is my conviction pick. And the reason why I say that has got a few things that I want to highlight. If you, I apologize if just now the slide, I'm not sure whether you, it was already shared on screen or not, but basically for AEM itself, right, you look at it, they're the only company that's come out with revenue guidance. So they actually do have revenue guidance for 2022. They're showing you double-digit year-on-year revenue growth. And when you look at a track record, I'm not saying that they will do it again this year, but if you look at track record, they tend to be able to actually do better than the revenue guidance. I think one of the reasons why they can do revenue guidance and how they can do better is because they do have an order book from Intel. And as far as I can understand, in terms of the lead time for production, you typically need to tell them roughly, even in today's terms, probably still 6 months ahead. So if you were the management of AEM, actually should be having a visible order book 6 months ahead, and therefore that will actually help in terms of being able to give a revenue guidance. But of course, that said, the risk you want to watch out for is that it is a revenue guidance. Customers have issued the orders, but in this industry, customers can delay orders. But of course, we are not seeing that or assuming that for now, but that's a risk to be mindful of. And the other thing is that you notice that if you actually follow the stock back in maybe 18 or 19, they already address or realize the need to diversify. But it's taken very long because it's not something that you can just do with a snap of fingers. But if you look at it now, they are actually more comfortable in coming out to tell you that they hope that FY22, they will have 10% of revenue from other customers, which is actually quite positive. And the reason why they can do it is that now there's this demand for system level testing, which is actually sort of more of a level field. In this field, they can actually compete against the Teradyne as well as Advantest, which the other two big players in this industry. So if they are successful in doing that, they can actually grow to become a more meaningful revenue and profit company. And so far, I think if you look at how they renew management and how they focus on the business, I think generally speaking, I would say that they have done pretty well on that. So I would say that AEM is probably the top pick. And next company that I'll probably be quite comfortable with is your Grand Venture. I like it more because of the growth focus of the company. In terms of the Singapore space, not many companies actually have such aggressive growth plans. So although they have done quite a fair bit of fundraising, you have noticed that they have actually also delivered in terms of trying to do the acquisition as well as trying to increase wallet share as well as doing more with existing customers. And the next one probably will be more UMS. I think the only issue that I need to be aware of is a taxation issue. Because as far as I can tell, demand-wise is definitely not an issue. And I think that when their new factory is available end of the year, they can actually do more. And as the aerospace industry improve for the this JAP acquisition that they actually did, you will actually start to see contribution maybe in another 1 to 2 years time. So I'll run them in that order.
Also, the AEM's links with Intel, I think the big sort of news for Intel recently, which is hype, I think, is that they've developed a new crypto mining chip that they're about to release. So we don't know how much the take up for that will be. I've been looking into it, and a lot of the current ASICs makers are saying that it's not really that competitive. There are a lot of big claims. Do you think AEM is going to benefit from that if it does take off, or is there a risk if it really, it turns out to be something that's a bit of a failure?
Okay, I think the more important thing is the overall market for Intel, not just one product specific. So there are two things you want to take note of. In the space itself, basically the main chip makers, your AMD, NVIDIA, and Intel. So it is really known knowledge that whereas in the past, let's say if you look at 10 years ago, or 20 years ago, it's only Intel. I mean, mainly if you buy whatever, it's Intel chip. Nowadays, you have AMD chips, you have ARM chip, Apple is doing its own chip, and NVIDIA actually last week already announced that they're going to have a CPU chip other than what they're traditionally been doing, graphics chips. So competition is actually increasing. But at the same time, you notice that all this demand is also increasing, so the market is actually growing. So I think Intel will actually retain its fair share of the market. And also, if you look at it, Intel under the new CEO has actually revived what they call Intel Foundry Services. They actually used to do chip fabrication for other players, but that really didn't really take off because they are more their own product, own brand company. But under the new CEO Pat, he's really aggressively driving this, and also tells you that he also sees that besides Intel doing its own chip, there is going to be a big demand and big growing demand or big growing opportunity in this field. And if you look at NVIDIA, even NVIDIA is saying that market is going to be too big. We will actually not be able to have TSMC do everything. In terms of diversification, we are open to talking to Intel. So I think you would probably want to see more in terms of the development of industry and not so be more so focused on any single product category that this Intel is developing. Overall, I would say it's still quite positive for Intel.
Thanks very much for that, William. Couple of questions next about counters that you didn't feature. I don't know how comfortable you are about talking about them. So two companies, Nanofilm and Micromechanics, both rather prominent Singapore tech companies also, but you didn't feature them. Could you just briefly talk about your opinions on them?
Yeah, sure. So for Micromechanics, because we don't follow and we don't cover, so we don't really have that much information or knowledge on Micromechanics. So I think it's probably better that we don't actually give the wrong information on that stock. But Nanofilm we do cover. So I think for us, when we look at Nanofilm, the main concern is actually always in terms of valuation, because this company tends to be more on a higher PE multiple. So after the listing, there were certain challenges in terms of their own need to actually to sort of invest in machinery, once-off items like power issues, not being able to link up to the power grid. So those are some of the concerns, and because of that, the stock price actually sort of derated. But the real issue you want to think about in terms of Nanofilm is what kind of valuation do you actually want to pay and are comfortable with. So before I talk about valuation, maybe I talk about the fundamentals first. Fundamentally, I think they don't have too much of an issue. They have certain proprietary materials, certain proprietary coating technologies. They have good customer in terms of, I think, probably widely known or suggested to be Apple. They actually have one of the two or three, probably two. There are actually two alternative suppliers available, but no one does it on a scale basis. Meaning to say you can actually go to only these two suppliers and say that let's do on give me 10 units, 100 units, they might be able to do it, but give me 10 million, 20 million, they don't have the capacity. So effectively, they are the main supplier in those product categories. So they also have hydrogen investments, just talking about hydrogen for new economic cars and so on. So quite positive about all these things that they are doing. So really going back to how much do you think you one is willing to pay into the valuation for this company, whether you want to pay 20 plus PE and so on. Because generally speaking, for the tech industry in Singapore, you look at the history of the stocks in Singapore, very, very rough thumbs is generally always a range of 10 to 15 type of range. So it's very much in terms of the valuation. And I think that perspective will only change if they actually start to see or report very strong, like 30-40% EPS CAGR again, then the market will actually be a lot more aggressive in actually rewarding the share price. Or the other thing that can happen is they actually give you earlier positive news on the hydrogen joint venture, such as things releasing revenue, profit figures on that JV, or even suggestions of them having grown their business big enough to do a separate listing.
Thanks very much for that, William. So next one's a bit of a fact check, because yesterday there was a speaker who talked about Singapore's share percentage of the chip market, or its contribution to the chip market. The figure was about 17%. Is that the sort of impact that Singapore has on the chip market, actually?
I didn't attend essay session, but I suppose he is talking about the general electronics exports. It could be a percentage of general electronic exports. And the reason why that there's 70% is Singapore actually do have fabs. If you recall the old days, we have Chartered Semicon. So in addition to Chartered Semicon, you actually have the UMCs actually does have fabs in Singapore, as well as even your Micron and some of the other MNCs, they do have some fabs, mainly in the Pasir Ris Woodlands area. So that 70% figure could actually be talking about those electronic exports from these fabs. But in general, when you look at our coverage, they do not make the chip itself. They say none of these companies make the Intel chip. They are all suppliers to these end customers.
Thanks very much for that, William. Actually, a quick one from me, because you mentioned about the links some of these companies have with companies like Applied Materials. When you consider that, if you look at the high end, the most sophisticated chips, those come from TSMC. They're the ones that can make the smallest transistors. They're the ones on the cutting edge. Applied Materials is a bit more mass market, right? With regards.
Okay. Okay. Maybe let me just also make some clarification on that, because when you look on the top level, right, the chips makers that I mentioned, this will be the TSMC, your UMC, Intel, Samsung. These are some of the key players. I mean, there are others, but these are basically most of them already. So when you talk Applied Materials, Lam Research, these are what we call the front-end semiconductor equipment makers. So you need equipment from these companies to actually integrate into your chip making facility in the fab in TSMC or in Intel.
That's a very important clarification. So thank you for that, William. So one more question about a counter that's not on your list, Aztec. Yes. Any views on that?
We do cover Aztec. It's just that for this talk, we chose to focus on semicon. And the reason mainly because you can actually see that semicon is less impacted. Because remember, I said that I call this a basket of semicon stock, a basket that supports the long-term semicon industry growth trend. And I mentioned that contract manufacturers like Aztec or Ventures, they need to use chips. So for Aztec, for example, if let's say there is no chip availability, let's say you go back to last year where things are very bad, you just cannot get chips. Whatever chip it is, whether it's power chip, whether it's other components like resistors or capacitors, then you cannot make that product. And if you cannot make the product, your revenue, your earnings are affected. So currently, the situation for them is the components availability is, I mentioned on my slides, improving, but not satisfactory still, so it's improving. So he would rather basically have really, you can have the chips available, I can do a lot more. So he can probably, or Aztec can probably outperform what the market is expecting for this year if you can have all the chips. So then you will ask, why not just use up all your cash and buy the chips? Then so it's a bit difficult because you will be too much of a drag on working capital. And if the situation actually does turn, he'll be saddled with a lot of high cost inventory. But other than that, I would say that now it's more of a value stock. The P multiples have derated. He actually been paid. He actually announced quite a good dividend, so you have quite a good dividend yield. You can just check my report, but if I remember correctly, it's probably like 5 to 7% of dividend yield at this kind of prices.
Wow, that's actually very solid. And so, William, unfortunately, that's all the time we have. Thank you very much. So, folks, that's Mr. William Teng from CGS-CIMB talking about Singapore's tech stocks. If you missed any part of that session, you definitely want to check it out again. The recordings will be available next week. And here's to let you know, coming up this afternoon, akan datang, we will be talking about the construction sector. We'll also be talking about investing with an inflationary environment, and we'll be ending off this afternoon by looking ahead to what awaits Chinese stocks this year. Massive moves in China over the last few days. Is it too late to jump back into Chinese stocks? So come join us again this afternoon at 1 p.m. Please do check out our exhibition hall. Head out into the main lobby. It's the arrows on the bottom left. So follow that into the exhibition halls. There's exclusive content, there are promotions put together by our sponsors and participating brokers, and there's also the option to chat live with them. All right, you can click on chat on the very furthest right side. There's a lady standing there. Then you'll be able to chat with their representatives who are online. In the meantime, enjoy your lunch break, and we will see you back here at 1 p.m.